Hi guys, hi. So I'm going to talk about really I wanted to talk about um, groups, but then I just felt I had to sort of summarize corporation tax, and then I suddenly thought there were two of you missing in the class. So I just thought let me just go through corporation tax introduction, go through the losses, and then get to groups because it's all somewhat connected, isn't it? But I won't do all the exercises in the first two chapters, as in introduction, corporation tax, and in losses. You can go through those, but then I'll do the questions in the groups. So let's begin. Again, of course, these will be a series of short videos that you can sort of go through again and work on. So let's begin. So corporation tax introduction. I mean, of course, if you were in class, you can skip this, but you can always look at this again for your own sort of revision. So really, what we kind of we're trying to talk about now, we're talking about the company, right? This is the company, and the rules are slightly different here in terms of the financial year and this idea of what we refer to as a chargeable accounting period. And the period of account really is what you, as a company, will prepare your accounts to. So you can have a period of account that you might go from 1st of January to the 31st of March, if you like. Um, this could be 16 and this could be 31st of March 17. So this could be your period of account. But fundamentally, you're only allowed a 12 months, only a maximum of 12 months are allowed when preparing company accounts, if you like. So we refer to them as chargeable accounting periods. Right, let's kind of go through and look what you were dealing with. But here again, you can go through this, but I just want to go through it so that it's so it flows by the time I get to group. Right. So what did we talk about? We talked about this, like everything I just mentioned, the fact that we deal in chargeable accounting periods. What was also interesting here was that we included, you can see here, the gains that a company, the capital gains that a company will make during the year as part of its taxable total profits. If you remember with the sole trader, we will talk about trading and income, we will talk about employment income, we will talk about pension income, if you like. We could talk about property income, but we never included capital gain with this. Capital gains are treated separately with its own annual allowance. But when we come to talk about the company, we work out the capital gains as we go along. So fundamentally, really for you guys, there's not too much going on. I mean, apart from when we talk about groups, but really this idea of residency. Typically, a company is, if you register with his house, you're definitely, and if you're not registered with company house, but you are centrally managed and controlled, so really your board, you have a board in the UK, and most of your trade, at this level, we're not really interested in what percent, but predominantly most of your trade takes place, then you would be considered to be resident in the UK and therefore will pay tax in the UK. So very similar to what happens with the individual, where an individual comes and lives in the UK for more than 183 days. So it doesn't really matter where they're from. As long as they've lived in the UK for 183 days in that year, they would be considered resident. And so the same applies really to a company in terms of this idea of having resided in the company for a period of time. Right, let's go on. So I talked earlier on about this idea of a chargeable accounting period. And first of all, it cannot, this is the big issue here, it cannot exceed 12 months. So you would typically record it from when the company starts to trade, or if you like, when it acquires a source of income. So typically this might want to start to trade, and it might say something like, okay, it has good plans on the 1st of October, it wants to start, but for whatever reason, trade only begins, if you like, in January. So you can, if you like, adjust that to be your starting point, if you like, when you start receiving actual income and actually starting work. So just because you register here doesn't mean this is when you actually start to trade. Right, and when does it end? So typically it will end, of course, 12 months after it begins. That's the normality of it. But of course, if you cease to trade, then, well, that's the end of the chargeable accounting period. So I think that's the first. Again, I like keeping these short so that you're, like I said here, if you do have a long, so you're free to, of course, have a long period of account. for example, 1st of January 2016, for example, to the 31st of March 2017. So here, what we really have is a long period, and what you have to do is split this up into two chargeable accounting periods, right? Two chargeable accounting periods. So the first one is always the first 12 months, and then you have 3 months, if you like, as your next period. So you split this up into two chargeable accounting periods. So chargeable accounting period 1, chargeable accounting period 2, and you deal with them separately. I'll just throw this in now. When you're dealing with your capital allowances, you will do exactly the same thing. You work out your start here, and then work out your tax written down value to here, and you will carry that over and do that for 3 months. just because I'm here now, your capital allowances, you will only ever get the AIA maxed out at 200,000, right? Because you cannot extend it like you would a sole trader for more than 12 months. So that's the max you would get. And here you would apportion it, of course. So short periods is normal, as you would anyway. You would always apportion, won't you, WDAs and your A's, right? Remember that FIAs always stay at 100%. Right, let's carry on very quickly. So I'm not going to do the examples in these videos just because you can go through them and because I did go through it in class. So like I said, that's your first CAP and your second CAP, if you like, is the splitting of that between two periods. Cool, great. That's the end of the. Oh, I mean, okay, why not? Let me just do this one. Is not too tricky. I can do this. Well, when I say I can do it, yeah, 1st of April, take that all the way to the 31st of March. That's one chargeable accounting period done. And then the next chargeable accounting period, of course, is the 1st of April to the 30th of June. And that's your second chargeable accounting period. Great stuff. That's the end of that first video, and I'll see you in the second video.